stock dividends, and stock splits. A stock dividend is a form of dividends that is issued by a corporation instead of issuing cash dividends. And the reason that corporations do this could be that they want to satisfy the stockholders' expectation of receiving dividends without spending actual cash. It also puts more shares out into the market. And if there's more shares out there, that it can increase trading and increase marketability of those shares of stock. It's also a great way for corporations to emphasize to their shareholders that their equity is being reinvested in the business and that it's growing the equity side of the business. And so for stock dividends, there's two types, small stock dividends and large stock dividends. A small stock dividend occurs when a company issues a dividend that is 20 to 25% of the corporation's currently issued stock. In that case, the dividend is recorded at fair market value. A large stock dividend, then, is when a corporation issues a dividend that is more than 20 to 25% of the currently issued stock. And in that case, because it's such a large amount that could increase the market value, those are recorded at par value. And so you can see that it's a range here of 20 to 25%, and that's because there's other factors that can influence whether or not a stock dividend is considered a small stock dividend or a large stock dividend. And so in our course, and also in this video, we are only focusing on the small stock dividends. So let's look at an example of a small stock dividend. Westland Corporation declares a 10% stock dividend on its 50,000 shares of $10 par value common stock. So this tells us that the corporation is going to issue 5,000 new shares as a dividend. And so now we can calculate our journal entry to record on that declaration date. So if they're issuing 5,000 new shares that currently have a market value of $16 per share, the overall dividend amount is worth $80,000. And so we're going to debit into stock dividends $80,000. And this debit to stock dividends reduces equity. Now we need to take that $80,000 and split it between the par value and the amount in excess of par. And since our shares have a $10 par value, the 5,000 shares at $10 par each comes out to $50,000. And so that is the par value of the shares that are going to be distributed to shareholders. And so we credit that into an account called Common Stock Dividends Distributable, meaning this is the stock dividends that we are going to distribute to the shareholders. Which means the remaining $30,000, the amount in excess of par, gets credited into paid-in capital in excess of par for common stock. Now, on the payment date, all we need to do is decrease the common stock dividends distributable and increase the actual common stock account. We've already recorded the value of the dividends. We've already recorded the amount in excess of par. We only need to show that those stocks have now actually been issued. So if we look at a chart here, you can see that before the dividend, Westland Corporation had $800,000 in stockholders' equity. And after the dividend, they also have $800,000 in stockholders' equity. The difference is that the corporation has used $80,000 of retained earnings when they debited that stock dividend account and converted it into paid-in capital. $50,000 of it went to the common stock account, and the $30,000, which resulted from that increase in the market value over the par value, went into the paid-in capital in excess of par account. And then if you look at the shares outstanding, they started with 50,000 shares outstanding. The corporation issued 5,000 more, and so after the dividend, they have 55,000 shares outstanding. Now let's look at a stock split. A stock split is different in that it is issuing additional shares to stockholders, but it's basically taking the shares that they have and splitting them into multiple shares. And so what happens is the par value or the stated value of the share is reduced, but the number of shares outstanding increases. And so this is done in proportional amounts. So if the shareholder was had 2 shares and you do a 2-for-1 stock split, they end up with 4 shares because they get 2 for every 1 that they had. Okay, and so what this does is it reduces the market value of shares, because basically you're doubling the number of shares that are out there, and so the supply goes way up, which causes the market price to go down. And the reason the corporation might want this to happen is because sometimes stock prices get so high that you're pricing a lot of investors out of your stock. Okay? But the good news here is that for a stock split, there's actually no journal entry needed. This is more of just like a record-keeping type transaction. So if Westland Corporation decides to take 50,000 shares and do a stock split on a 2-for-1 basis, there's no journal entry, which means there's actually no change to the stockholders' equity section at all. The only thing that happens is they originally had 50,000 shares outstanding. Because it's a 2-for-1 stock split, we're going to multiply that times 2, so now there's 100,000 shares outstanding. And our par value was initially $10, but we're going to split that in half, and so it becomes $5. So before we had 50,000 shares at $10 par, which was 500,000 in common stock. Now we have 100,000 shares at $5 par, which is also 500,000 in stock. Okay, so here's a little summary that shows the difference between stock dividends and stock splits. A stock dividend is going to increase the common stock account in terms of dollars. It also increases the paid-in capital overall section of your equity. It usually decreases retained earnings because you use retained earnings to issue those shares of stock. But overall, total stockholders' equity, the entire stockholders' equity section of the balance sheet, does not change. And the par value of the shares does not change. On a stock split, there's no changes to any of the dollar amounts, but your par value per share decreases because you're taking each share and basically splitting it into smaller shares.